So today lesson key focus is financial reports and performance, how we can measure, and go through now. So of financial statement. So financials and under IS4 evaluate specific organization, which will go through when the process. Okay, welcome. Sorry for the issues. Okay, so 3.1 will go through accounting records for the specific organization. We'll discuss about how we can draw the recommendation for improvement. We'll discuss ratios, financial ratios, and evaluate different financial reporting. That all will be in our discussion today lesson. And we already discussed about micro and macro organization in the previous lesson, financial reporting councils. We had a discussion how these, the micro companies and small and medium sized organization. So that's, the which we can further enhance our discussion. So FRC, Financial Reporting Council, has issued the various, the changes into the law in response of the implementing EU accounting directive. Those are FRS, which is 105, which we're looking the financial reporting standard application of the micro entities, with their treatments and other changes which we can look around under 105. FRS 101, which is about reduce the disclosures, the new standard which was released in back, in January and 2016. Okay, so micro mean the definition about the micro entity, which is consist of, in the section we have under the Company Act, which we can look around the qualifying conditions should be met, the turnover, it should be, and the balance sheet, the worth of the assets, net assets should be, and the number of employees 10. Yes, these are clustered as a micro companies. They have a separate treatment as well, which we can look around further. IES and financial reporting standard, which we have, 102, which it deals with it. So which we can further, depends upon the situations, accordingly we can treat. And that's, which we can look around the accounting estimates and things, accordingly under this standard. Okay, so we are interested today lesson key focus is the use of the financial statement. When we interpreting the financial statement is important, we can look around the user of accounts. We can look around sole trader, partnership, various stakeholders. Stakeholders mean anybody who has any interest in the company, the user of the financial statements, and those, which we look in detail. So financial ratios is help to measure the performance of the company. We all work in accounts, so you already know these ratios, but it's quite good to be, we not only relies on these financial ratios. Other than that, we can look around various external environment as well, political, economic, social, and technological environment. This is also crucial. So when we prepare the financial statement, major we can categorize into the 4 categories: liquidity, financial position, profitability, and use of resources, also known as efficiency ratio. So when we say current ratios, is also known as the liquid ratios, which is mean converting into cash or cash itself, those are most liquid. So current asset divided by current liabilities, which we can find from the balance sheet. Quick ratios are, we call asset test ratios, because sometimes inventory is not most liquid, so we can take out the inventory. So normally benchmark is 2 to 1, 2 pound worth of asset, 1 pound worth of liability. And we can look around under the quick ratios 1 to 1. Interest cover ratios and gearing ratio, like if you drive in a high gear, high risk, so if the ratios come high, so it can be high risk. Profitability, we can look around and use of resources on the next slide. Please, you can stop me if any particular question you want. Okay, so we can look around the return on capital employed. So all these formulas and the separate formula sheet is also available on Moodle, which we can look around. Profit from operation divided by the total equity plus non-current liability. When we have a non-current liabilities, so that's we borrow money for the sake of to investment. Huh? That's why the profit from operation divided by total asset, profit from tax. So return on equity, gross profit percentage, net profit percentage. These all the ratios we can calculate under the profitability ratio. Use of resources are we call efficiency ratios, cost of sale divided by inventory. So we can find inventory turnover days, inventory turnovers, how many time inventory being turnover in a year's time. Trade receivable, always trade receivable days should be lower than the trade payable days. So we have a safety net. So working cycle, we can look around inventory in days plus receivable days minus payable days, which we can find by using. So these are all the formulas. We're not going to use all, but you can pick, one ratios according to whatever your interest within these ratios. So ratios help you to measure the performance. We can calculate ratios from the current period, previous period, always good to be compared at least 2 years. Huh? We can compare with the industry averages. These are the ratios, maybe one sector, another sector. It can be vary the industry to industry. So we're not supposed to be. So we can make various economic decisions. So these are all the ratios and their interpretation, return on capital employed, profit from operation divided by. So when we need to interpret, we can say it shows the relationship between two things, profit from operation, total equity plus non-current liability. So that's the way we can calculate by using the formulas, which will look, return on equity. Yes, measure the return ordinary shareholders, because when we'll say return on equity, so we're looking after the tax profit, not before the tax profit. Yes. So that's the equity we pay the dividend after the tax, because the tax is also, so that's why debt is cheaper than equity. If you want to borrow money, so debt is normally cheaper, but we want to look around the gearing ratios of what effect will be if we have a more debt compared to the equity. Any question from anyone? Okay. Then we can look at expense percentage against the revenue. We can look around asset turnover ratio. Yes, revenue, total asset minus current liability. We say net asset. So we can divide it and we can calculate the ratio. Liquidity, as we mentioned, current asset divided by current liability. Benchmark is 2 to 1. £2 worth of asset, £1 worth of liability. That's the good benchmark. Yes. So that's we're looking and we need to compare it. Any question from anyone? We all okay? So this, we can look around liquidity, current asset divided by current liability. And when we look the quick ratios, asset minus inventory divided by current liabilities. Okay. So when we looking these ratios, so always look around, interpret these ratios, look around the company. So not only these ratios, we can look around at the moment. How much is the base rate? We all know how much is the basic interest rate at the moment, which we call base rate. Yes, please. Anyone? What is the base rate at the moment? Yes, please. Can you hear me okay? So what is the base rate at the moment? Basic interest rate, which all the economics activities is based on, yes? So when we look the, yes, please. Is it 5.2? What do you think? Is the 5.5 is the base rate, basic interest rate. This carry on increasing and decreasing. Yes, is by always good to be when we do these, we can look around the monetary policy and we can look around the fiscal policy. So monetary policy is the policy of the central bank, and fiscal policy, the policy of the government about in taxes and spending, and that's also affect, we can look around other factors. Best political, economic, social, and technological factor, which is also crucial to look around. Okay, so then we can look around financial position, gearing, total non-current liability divided by total equity plus non-current liabilities, and profit from operation divided by finance cost, so we can find it interest cover ratio. So we can look around whichever company we are doing, so we can measure the performance accordingly. Okay, let's please. So we're looking two companies. So the data we got it from their income statement and the balance sheet. So we can look around the gross profit divided by the revenue, also known as sales and turnover. So we can find the Nika's coming 45%. So their revenue was 16,200 divided by, so which we can find the information which is given our financial statement. So we just using the formula we can find, so 45% is Nika and 52 is Papika, and operating profit is we using the formula operating profit which we can find from the statement of comprehensive income, or we call profit and loss, and we look around the Papika. So Anika and Papika, what do you think, by looking the gearing and this, which company we invest, or which company is performing better than others? Hello, can you hear me?
Yes.
Yes, please. So what do you think? If you look the profitability, which company we look, is the best? So when we look, the Papika is performing better than Anika. So because Anika's gross profit is 45 and Papika's is 52. And we can look around operating profit is 9 and 11, and gearing ratios we can look around 13 and 71. So according to the profitability, Papika is better. Maybe your argument can be, when we interpret these ratios in detail, so what you can look around, maybe you can look around their cash flows as well. Yes, you can look around other factors, because maybe these are all the credit sales. Yes, sometimes we can enhance the sale by giving the credit. So the ratios look good, but interpretation and using them accordingly, according to your decision making purpose. So we can look around Anika's is 13, Papika's is 71, alternative gearing 15 and 245%. That's, Papika. So Papika is more risky than Anika. So we normally say in the business, higher the Papika, sorry, we say higher the beta. Beta, what is the beta? Beta is called risk factor. So we can say higher the beta, higher the risk factor, we expect higher return. Yes. So beta is a risk factor which we can either, if you go on the Yahoo Finance, we can look around beta of Amazon, beta of eBay, and you can decide which one you want to go, and you will see this. Yes. Interest cover ratios, profit from operation divided by interest, are we known as a finance cost, which we can find the figures from the statements. And it's coming 11.2, 11.6 times is a higher, and Papika is 3.1. So if the three times our profit drop next year, so we're not in a position to get the money back, if you're a lender. So that's, which we can look in. Asset test ratios, current asset minus inventory. So it's always asset test ratio. Normally the benchmark is 1 to 1, £1 worth of asset, £1 worth of liabilities. So if it ratio is coming 1.2, is quite good compared to other Papika. Papika's liability is more compared to the asset. So this indicates, so we can compare 2 years, we can compare with different industries, different companies to decide, which company is performing. So next we're looking the company performance, maybe compared to the previous period. We can look on the past result. We can adjust, effect of the price changes, because, the carry on happening the price, because before COVID-19 is maybe the ratios look good, but during COVID you'll need to make sure look the current circumstances and limitation of the ratio. What we can do, we can look on horizontal analysis we can do as well, which is quite good to look around, which we can, yes. So try to overcome the problem of vertical analysis. It commonly compare the company performance for the particular period with performance equivalent to the company in the same period. Yes, introduce the independent yardstick or the benchmark, which we can look around various industries, and you have to compare it to measure the performance. Okay, we can compare with the industry averages. It's quite good to be look around what is the industry average. Each industry, like hospitality industry, like in the hospitality industry, we say, the return need to be more than 100, 200, 400%. People say in the food sector is profit is a lot, but depends upon the competition and depends upon, number of other factors as well. The taste and the fashion, the food hygiene and the license and other, governments also need to be keep in mind before you decide. So consider the business strategy. So please, it's quite good to look around uh, by one of the model. It's given by the Norton, the author Norton Kaplan. It's called Balance Scorecard Model, BSC, Balance Scorecard. So always look around the company, not only look around Balance Scorecard Model. So what they're doing, because it can be different perspective, financial perspective, innovation perspective, investment perspective, research and development. So because like Nokia was ratios good, but what's happened? Nokia stopped investing money on research and development, stay behind, not launch the product which is meet the customer needs and want, ultimately stay behind. Maybe the ratio look die is good. So not only we rely on the ratios, but look other circumstances, future strategy of the company, and then make the decision either to invest, either to do the job, either you deal with them or not. So trade receivable days, let's say 30 days, trade payable days 60 days. The difference is 30 days is a safety net. So always try to be look around payable days and you negotiate. Okay, so user of financial statement, investor, potential investor, lenders, suppliers, customer, government, yes, and public. These are all the users. So different purposes they have. Investor want to know about where they invest in the shares and the dividend. Future investor want to look around the company, what they paid into previous, and lenders, they want to see their money secure. Supply, they want to give the credit and get the money back. And the customer, they want information, a guarantee, warranty. If the company gave, that they are sure because the company financially not strong, maybe not sustain. So as we seen, Papika and Anika, the company, so gross profit is better in Papika, operating profit better in Papika, gearing ratios better in Anika, and interest cover ratios, Anika, asset test ratios, Anika. So based on all these, we can say, yeah, as an analyst, you can decide, make the decision which company you will invest and why. And we can say Anika is betterly performed compared to the Papika. And this, we can further look around the limitation of the ratios, please, and interpretation of the ratios. For further reading is the link here. Anybody, any question, please?
No, thank you.
Thank you. This week, we'll look around the financial performance, which we measure through the ratio analysis. And we have 4 types of key ratios, which we discuss: profitability, liquidity, use of resources, and the gearing ratio, or we call financial position ratio. So these are the ratios. But other than that, we can look around micro environment, microeconomics factors, what is happening, and look around the future strategy of the company, and use the balance scorecard, or look around the limitation of ratios. Yes, we not rely on just on the ratios. Okay, that's all from this week. We're looking the financial ratio under the LO3, and then we'll go through LO4, and we'll go through our assignment discussion following weeks. Any question if you have, please? Anyone? Yes, yes, no question. Okay, thanks for attending today's session, and those will attend tomorrow. We'll go through the art taxation. So please, if you have any question, all the books and journal articles available on the ratio. If you have particular question, please always ask. Thank you. Thanks for attending. Maybe it's a very basic fair, but we already in working in accounts, so matter of looking the ratios and applying these, because it's only your assignment and we need to do assignment, which will do the assignment discussion, and we'll go through the various resources how we can write and address all the learning outcome. Thank you. Have a lovely weekend. Thank you.
Bye-bye.
Thank you.
Thank you.
Bye.
Bye.
Thank you. Bye-bye. Thank you.